Hi, I'm Tom Lydon here in San Diego at the Charles Schwab IMPACT Conference here with Dodd Kittsley, National Director at Davis Advisors. Great seeing you, Dodd.
Great being here as always, Tom.
So there's a lot of talk about active management in the ETF space. You guys were at it early in active management, and especially in a transparent way. How did you have the foresight to do that?
Well, clients asked for our strategies that have been around now for 50 years in an ETF format. Many advisors that have transitioned their book of business over to be more ETF focused. For those that really wanted to reserve a place in their portfolio for active. So we did it to really provide choice for folks that saw some of the great benefits ETFs offer relative to mutual funds.
Yeah. It's not one or the other, as you
Right.
point out, it's choice. So you have a lot of clients. Again, you're a firm that's been around for 3 generations, 50 years, done great with mutual funds, but thought, hey, because of what your advisor clients are saying, you'd like to offer ETFs too.
Absolutely, yeah. It broadens the opportunity set and the access that for more advisors to be able to really access our time-tested, proven active management that has outperformed over long periods of time. And it's really differentiated, right? Because when you think about the ETF space, it's indexing, it's smart beta, some thematic, but active and manager discretion is something altogether different that really can add something to a portfolio.
And when you look at your suite, very high conviction in
Yes.
certain areas, and the idea that it's transparent, you can actually go to your website every day and see if there are any changes, right?
Yes, I mean, we're talking 25 to 35 different stocks. So these are all best ideas. And to your point, it is completely transparent because it can be. We primarily invest in large liquid securities. So some of the concerns other managers had about front running or giving away the secret sauce really wasn't in play for our firm. And we had the luxury of now having a 3-year track record of having actively managed ETFs in a transparent form.
One of the best stories I like is you look at the financial ETF, and I'm not going to mention the company, but it's something like $16 billion, is that right?
Even bigger, yeah.
Even bigger,
yeah.
okay. But there are 5 banks that make up about 45% of that index.
Yes.
Which means that you're kind of betting on a few companies from a cap-weighted standpoint. What Chris Davis has always said is, hey, not all banks are created equal.
Yep.
It's important to pick and choose. And if you do your homework, that pays off over time, right?
It certainly can. A lot of folks think if they're going into a market cap weighted index, they're getting instant diversification. And it's a bit ironic, but going to an active strategy can arguably give you broader exposure to more segments of the financial industry and really handpick some of the best run companies, because the dispersion of performance between financials is the greatest out of any other sector. So arguably that's a great fertile area for active to really add value.
And then finally, this whole thing about passive leading and active not being popular, everything reverts back to the mean.
It certainly does. I mean, there have been long-term periods where even the average active manager has outperformed, but we think that's not really the right question to focus on. It's not how the average does. It's really not settling for average and looking for active managers with characteristics that's going to put you a couple steps ahead of everyone else, being high conviction, being low cost, having skin in the game. Those are really things that advisors should look for when they're selecting an active manager that's going to put them in a position to outperform.
Yeah. They're not all created equal, and as Chris Davis himself said, there are a lot of active managers that really suck.
There are some terrible ones out there, right? High cost, those that look very much like the index. If you want broad diversification, you go with a low cost index product. If you want good active, you want best ideas, you want high conviction, you want something that looks nothing like the broad benchmark. And that's why advisors like our ETFs, because they're so different. So you can really pair them with a low cost, broadly diversified product and have a much better portfolio and be in a position to outperform.
Absolutely. Dodd, as always, great seeing you. Thank you.
Thanks so much for having us, Tom.